Hey there, investors. Today we're diving into something that's been on everyone's mind lately, the great investment shift between Europe and the US right now. The mood among professional fund managers is more pessimistic than it has been in years. Facing economic uncertainty and geopolitical risks, many investors are pulling their funds out of US markets, shifting towards European equities and holding more cash than ever before. So, what's driving this big change? Over the past few months, the global economic landscape has changed dramatically. Investors are worried about two key issues. First, the growing risk of a recession due to protectionist trade policies, particularly in the US. Second, persistently high inflation that could force central banks to rethink interest rate cuts. These concerns have led to one of the biggest shifts in portfolio allocations in recent history. According to the latest Bank of America Fund Manager Survey, European equities are now the most favored asset class among institutional investors. Germany's new fiscal policies, which include increased government spending on defense and infrastructure, are expected to boost economic growth. Meanwhile, US stocks have seen a record drop in weighting within institutional portfolios. Investors fear that economic growth in the US could slow down due to trade tensions and potential policy changes. At the same time, professional investors are increasing their cash holdings. The latest data shows that cash levels are at their highest point since the early days of the COVID-19 pandemic. This is a clear signal that fund managers are preparing for potential market turbulence. Historically, a sharp increase in cash holdings has often preceded periods of economic slowdown. So, which sectors are benefiting from these investment shifts? Winners, European banking and healthcare stocks are seeing strong inflows as investors look for defensive assets in times of uncertainty. Losers, US equities, especially in the energy sector and certain technology stocks, are being underweighted in portfolios. One interesting trend is that while US tech stocks, particularly the so-called Magnificent Seven, were highly popular in previous months, their appeal among institutional investors is now declining. When asked about the biggest risks to the market, fund managers highlighted three major concerns. A global recession triggered by a trade war. This was cited as the top risk, with over 55% of investors worried about its impact. High inflation. While still a concern, the number of investors worried about inflation has dropped in recent months. Uncertainty around US government efficiency. Some fund managers fear the potential impact of regulatory changes on economic growth. Despite fears of inflation, most investors believe that central banks will cut interest rates multiple times in the coming months. Market expectations suggest that 3 rate cuts could be on the horizon, which could provide some relief to struggling economies. In contrast to concerns about the US, investors are becoming increasingly optimistic about Europe's economic outlook. In March, 60% of surveyed fund managers expected European economic growth to accelerate over the next year, the highest level of optimism in nearly a decade. This is largely due to increased government spending, particularly in Germany, which is expected to drive stronger GDP growth across the region. So, what does this mean for investors? If you're investing in global markets, keep an eye on the shift towards European equities. The rise in cash holdings suggests that professional investors are bracing for volatility. Watch how trade policies evolve, as they could have a major impact on economic growth. If you found this analysis helpful, don't forget to like, subscribe, and hit the notification bell for more insights into global financial trends. What do you think about this shift in investment strategies? Let us know in the comments below. Navigate wealth with Svoboda Finance.